Trump's new tax proposal could change what you owe when you sell your home. What if a new tax proposal could reduce the amount you owe when you sell your home or cash out an investment? President Trump and his advisors are discussing two major tax ideas, and the difference between them could have a big impact on your money. One proposal would adjust capital gains for inflation. The other would increase, or even eliminate, the current limits on the tax break homeowners receive when they sell their primary residence. But here's the important part. Nothing has become law yet. Before we dive in, let me know in the comments, should you have to pay taxes on gains caused only by inflation? Right now, these are only proposals. Reports suggest that President Trump supports both inflation indexing and a larger home sale tax exemption, but the White House hasn't announced a final plan. And in most cases, Congress would still need to approve any major tax changes. So don't make financial decisions based on rules that don't exist yet. Let's start with inflation indexing. Imagine you bought an investment for $100,000 and sold it years later for $150,000. Under current tax rules, your taxable gain would generally be $50,000. The government doesn't usually adjust that original purchase price to account for inflation. But under an inflation indexing proposal, your original investment could be adjusted upward before your taxes are calculated. If inflation turned that original $100,000 into the equivalent of $125,000, your taxable gain could fall from $50,000 to just $25,000. Supporters say this would prevent people from paying taxes on gains that exist only on paper. Critics argue that the biggest benefits would go to wealthy investors with large taxable accounts. That's because you only benefit if you own investments, sell them, and generate taxable gains. Money inside traditional retirement accounts and Roth accounts follows different tax rules. According to one analysis, a broad indexing proposal could reduce federal tax revenue by nearly $1 trillion over 10 years. Now let's talk about homeowners, because this proposal is completely different. Current federal law allows qualifying single homeowners to exclude up to $250,000 in profit when selling their primary residence. Married couples filing jointly can exclude up to $500,000. But many people misunderstand one important word: gain. Your home selling price isn't the same as your taxable gain. Let's say you bought a house for $300,000. Over the years, you spent $50,000 on qualifying improvements. Later, you sold the home for $700,000 and paid $40,000 in selling expenses. In this simplified example, your taxable gain would be around $310,000. If you're single, the first $250,000 could be excluded under current law. That means about $60,000 might still be subject to federal taxes. A larger exemption could eliminate that remaining tax bill. So who benefits the most? Homeowners whose gains stay below today's limits wouldn't receive any additional savings. The biggest winners would likely be people with gains that exceed the current $250,000 or $500,000 thresholds. That's more common among longtime homeowners living in expensive housing markets. One study estimated that only about 10% of homeowner households had gains above the current exemption limits. Those households also had significantly higher average net worth. But there's another side to this story. The current home sale tax limits haven't changed since 1997. Nearly 30 years of inflation and rising home prices have made those limits less valuable over time. Many homeowners who bought decades ago have seen their home values skyrocket. A retired couple may not have a high monthly income, but their house could be worth several times what they originally paid. Selling that home could help them downsize, move closer to family, or pay for healthcare. A larger tax break could leave them with more money for that next chapter. Supporters also argue that lower taxes might encourage more homeowners to sell, increasing housing supply. But experts disagree on whether that would actually reduce home prices. Housing inventory, mortgage rates, and new construction would still play a much bigger role. There are already several proposals in Congress. One bill would double the current home sale exclusions and adjust them for inflation in the future. Another would completely remove the dollar limits. A separate Senate proposal would adjust certain investment assets for inflation. But remember, proposed doesn't mean approved. The current rules are still the rules you should follow. If you're thinking about selling your home, gather your closing documents, improvement receipts, and records of selling expenses. Those documents could significantly affect your taxable gain. And don't forget that rental use, business use, depreciation, previous exclusions, and state taxes can all change the final numbers. The bottom line is simple. Trump's team is discussing potentially significant tax changes, but no final rule exists today. Inflation indexing, higher home sale exclusions, and eliminating taxes altogether are three completely different policies. Until something officially becomes law, keep good records and plan according to the tax rules that exist right now. If you found this video helpful, make sure you subscribe to the Untold Compass, hit the like button, and share this video with friends and family. And tell me in the comments, should inflation-based gains be taxed, or should the tax code be changed?